Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, LiberalArtsBanker shares his winding path from a small liberal arts college to VP at Goldman Sachs in investment banking. Learn why he started out in a trading role, why he jumped to a prop shop after a few years, his advice on trying to build a career as a trader, as well as why he pivoted to IB with an MBA. Enjoy. LiberalArtsBanker, thanks so much for joining the Wall Street Oasis podcast.
Hey, thanks for having me.
So it'd be great if you could just give the listeners a short summary of your bio.
So I've been doing finance for about 15 years now. I started out of undergrad trading different kinds of derivatives, both in kind of a market making capacity at first, and then a proprietary capacity, for a couple of years after that. Phenomenal timing, if you think back about 15 years ago to go into trading right before the start of the global financial crisis. And during that time, I enjoyed trading, but I saw the writing on the wall in terms of, where the trading job market was going, which, obviously had a couple tough years there through the late 2000, single digits and into the early 2010s.
Mm-hmm.
So decided it was a good time to go back to business school, got my MBA at, a top 20 MBA program, not, one of the top 3 or 4, but with a definite eye into going into banking.
Mm-hmm.
Banking from my perspective at the time gave such a wider skill set and a transferable skill set and the corporate training to go get many different types of jobs. So everyone agrees that traders, you need to be smart, you need to be analytical, you need to have a great attention to detail, you need to be good under pressure. But, I didn't even know what EBITDA was at the time.
Yeah.
And it's hard to convince a corporate finance department or an M&A boutique or anyone to hire you, with a trading background if you don't even know the basics of accounting or corporate finance or modeling or stuff like that.
Fair.
So, the idea of going back to business school is to get into banking and then leverage that skill set that you learn both in business school and then with a couple of years of banking to get onto, something, that I found more interesting than the day-to-day transaction activity of banking, which, eventually will be hopefully the buy side somewhere in a private markets type role or in corporate development at a firm that's doing a lot of, M&A and you're really driving value, for one of your clients most of the time. So that's been the goal. I started out of MBA at a middle market bank. I called middle tier, mostly because that firm was one of the only firms that was consistently hiring through the financial crisis.
Mm-hmm.
Lots of European banks were cutting people, a lot of US banks were cutting people or not even having, MBA interns or full classes come in. So finding somewhere that was stable was very important, and finding somewhere that had a good financial institutions group was very important because I wanted to leverage the kind of 4 years I had on a trading desk and understanding that whole ecosystem into my banking career. So that 4 years I spent trading or 5 years I spent trading wouldn't completely go to waste because I would go cover financial institutions clients and I would have an immediate leg up on other associates or other, analysts or whoever else in the group who had never worked, in the trading or markets ecosystem. So started at, like I said, a middle market bank, was there for about 2 years. Quickly realized that the deal flow there, although I got to learn a lot about different areas of FIG, covering specialty finance and insurance and asset management, along with, capital markets focused fintech, the group did like one lead M&A deal in the 2 years I was there. And in my opinion, the things that make you valuable as a banker, both as a junior banker and then increasingly as a senior banker,
Mm-hmm.
Lead deal experience, your connection and network with your clients and other, intermediaries, lawyers, accountants, other bankers in the market. And then like your network in terms of, are you going to be able to go and eventually be a coverage banker, and who do you know and how comfortable are they with you? And I just didn't see myself getting that level of experience at the first bank where I was. So I had an opportunity to lateral. A retained recruiter for a large European bank found my resume on LinkedIn and said, "Hey, do you want to come in and work for one of the premier fintech bankers on the street?" And I had actually been on a bunch of deals where this banker had been leading the deal, and we were fourth or fifth bank down the list.
Yeah.
And thought, listen, if I'm going to stay in banking, and my ultimate goal is to get a really good buy side job or a really good corp dev job, I have a much better shot at doing it from this European platform where I'm going to get more lead deal experience, more, consistent with the bulge bracket experience, not a middle market experience. So, it might be painful for a year, like switching is not free, but fine, let's go do it.
Yep.
And that really played out, the level, the positioning of that bank on deals was far, beyond where we were at the middle market bank.
Mm-hmm.
The pace and intensity of everything picked up. And that experience was great. I had an opportunity to be the analyst staff for a while. I was there for a while, which is another good experience, kind of see the inner
Tough
workings of a
experience.
group. Everyone's always mad at you. The junior
Yeah.
people are mad at you because they don't feel like they're getting good projects or they're overworked. The
Yep.
senior people are mad at you because they feel like they're getting short shift on resources, or I'm not getting the best people, or
Right.
this took too long. So it's interesting. It was a good experience, but I never want to do it again. And 18 months was too long. So, but again, you get to see how the sausage gets made at the group level, how they think about staffing, versus revenues and stuff like that.
Got it.
Which is interesting. And it gets you more visibility with the group heads, which is never a bad thing as long as you don't stub your toe or anything. So spent 3 or 4 years at the European bank, got promoted to VP, was the staffer for a while, kind of pivoted my focus from spending most of my time in fintech for the first year or so I was there to spending most of my time covering asset management clients, mainly because there was more headroom on the asset management side of the floor. And I worked really well with the MD on the asset management side, and we got along pretty well. So that really kind of increased the trajectory of my career. And, I could have stayed at that firm and gotten promoted to director and possibly even MD early. And, the world was my oyster there, put it that way. But similar to what happened the first time around, a recruiter from my current employer, Goldman, hit me up and said, "Hey, we're looking to reform an asset management coverage team. We have a new MD who's going to do this. And we need a new, a whole new kind of junior apparatus beneath him. And, we need people with asset management experience." So, I came over to Goldman, and for the same reasons, really, again, up-tiering both the brand, up-tiering my experience in terms of leading deals, in terms of being a point person in front of, clients, whether it's CEOs or people running private equity funds or hedge funds.
Yep.
And given the area I cover, asset management, there's so much interconnectivity between the large bulge brackets in the U.S., especially, and asset management clients that if you're covering them, it's almost impossible to cover from a middle market perspective because, everybody who runs a private equity firm or hedge fund, 75% of them are alums of Goldman or JP Morgan or somewhere like that, or they have affinity for the firm for one reason or another, or they're big clients of the firm in securities division or whatever. So that's how you kind of get your hooks in everybody and make sure that you're having the right level of dialogue with the different clients across the broad sphere of asset management. It's been about 3-ish years at Goldman as a senior VP. Goldman doesn't have directors, so it's been a good experience. Awesome. And obviously a couple different stops along the way, but
quite a ride. So let's go all the way back to your liberal arts college. I went to liberal arts college. You graduated probably knowing next to nothing. You obviously didn't know EBITDA then, but tell me about how in the world did you end up at as a trader?
Yeah, so it's interesting. I had no idea I knew I wanted to be in finance, but I had no idea what the different job functions, the different types of firms, the different types of roles that were available to those firms were, because resources like Wall Street Oasis were not really in existence or prevalent back then.
Yeah, we
things
started
were done
in 06, your senior year we started.
Yeah. So things were done way more word of mouth.
Yeah.
And I went to a very highly ranked liberal arts school, but finance wasn't one of the big career paths that people generally chose out of my school.
Mm-hmm.
People tended to go to grad school more, or go to law school, or go right into different types of professions, but not finance. There was usually like a couple people a year tops.
Right.
So it was more networking amongst alumni, networking amongst my personal network, and just seeing what the few people I knew who were doing in finance, who were older than me at school, to get a little bit of a flavor what the different roles were.
Mm-hmm.
So it turns out.
Did you know what like investment banking was your junior year? Did you know what like trading was? And
I had like a decent idea, but I definitely didn't know. I didn't have the big picture, right? Which I feel like you can easily get the big picture reading the forums, reading the guides that are out there.
Now you can, yeah.
Now you can, but then it just wasn't available. I knew what like the analyst or the the junior trader role, how it was different. And really, I had two offers. I had a banking offer and a trading offer. And the banking offer was you wear suits every day and you work really long hours. And a lot of times you don't have any control over your schedule. And the trading offer was you wear a polo shirt and flip-flops and you work market-ish hours, plus or minus a couple hours before the market and after the market. And
were both offers in New York?
Both offers were in the Mid-Atlantic, I'll say. Not New York.
Yeah, okay, fair. So you basically had a chance. You could have gone banking right out of school. You chose the trading route. Besides the long hours and the suits to work, anything else that kind of pushed you to the trading?
So I was an economics major. My favorite sub part of economics was game theory. And I've always been interested in gambling, interested in playing poker. That was like the poker craze back like when we were in high school.
You a good no limit player?
Yeah. I've been known to throw the chips around a little bit.
Nice.
And that was, core to, it's just so similar to trading when you really boil down to it. It's both gambling.
How good at poker did you get? Did you study? Like, I ended up started studying it. I didn't go down to like the professional route, but I would play a lot.
I was very well studied. That was back when you could play online for money.
Yeah, and do well.
I paid for a lot of things in college with poker money.
How much do you think you made? Like 20,000, 50,000 more?
Probably a little less than 20.
Less, okay.
But and I also enjoyed it. Obviously, poker got a lot harder after everyone figured out how to play.
Oh yeah. Oh yeah.
In the years after that, but it was fun while it lasted. But trading and poker, they're so similar, right? They're both about making decisions in situations of incomplete information, and learning tendencies, and being comfortable with risk, and making probabilistic bets, even though you're not going to win every time, but being comfortable continuing to make those. If you say, I'm going to bet you $100 on a coin flip, but I'll pay you $55 every time you're right, and I'll take 45 every time you're wrong. You could lose 20 in a row, and you still got to take that bet every single time. And some people can get their heads around that, and some people can't.
So you never went on tilt, is what you're trying to say?
That's not true. Obviously not true. And it's funny because you think of traders like being like the ultimate, like just difference engines. Like you're just making these probabilistic bets over and over. But they were even worse than professional gamblers I know.
Yeah.
I worked at one trading firm where the guy who ran the firm, like the other partners in the firm had to close him out because he just kept doubling down on this one bet that kept going against him for like 16 months in a row or something.
Oh my gosh.
And it almost got to the point where the firm kind of sank, and they had to close him out. But it's hard to imagine somebody betting red in roulette would stay for that long or something like that, and keep doubling their bet until they win.
So you kind of choose the trading shop. You when you first start, what is it like? Obviously, did they have like any sort of training at all? It's a somewhat larger place. So did you feel like you got any sort of knowledge from that training, or was it basically 95% of the job? And did somebody take you under the wing? Tell me about those first few months.
Yeah, so it started off with a couple weeks of training in fundamentals. It was their primary asset class was options. So a couple weeks of options fundamentals, market fundamentals. They give you a little bit of like, here's how it works on different desks.
Were you trading as an undergrad?
No, not really.
No? Okay.
Um, and so they give you, I think it was like 5 weeks, and that was
How did you even get this job? I mean, coming from a liberal arts background, do you have people,
it was,
family, friends, or anything
yeah. So
kind of in the industry?
this firm going back a ways had always recruited, and my college was only about 20 miles from the firm.
Oh,
So
okay.
they always had recruited regionally. And their big thing has always been that they don't care what your background is. They could care less if you went to college. If you can get through the interviews and answer all the probability questions, and you get to the desk and you do a good job, and you get to your, we had competitive mock trading sessions every week amongst the junior traders, and you'd be fighting, and they'd keep track of how much money everyone was up or down. Sometimes we would play cards and have training people have the
Tell me about those competitions. What type of, was it options mostly? You were just trading?
Yeah, options. Yeah. So they would set up an options board,
Yeah.
open up some markets with bids and offers for different strikes. And you have to just kind of do math in your head. And they say, hey, I'm going to bid $6.50 for these calls. What does that imply in these puts over here? Or what does that imply in the risk reversal or the call spread? And okay, if I'm bidding $6.50 for these, do you want to sell these other ones at $7? Like, that kind of stuff.
And did that
Yeah.
take you a while to get up to speed, or just because of the
Oh,
poker
yeah.
natural,
Yeah.
it still took you a while? Like, when did you feel comfortable?
It takes a while to get everything in options is you're looking at, normal distributions of stock returns, and you're looking at different distributions of how things are usually priced across different strikes and different, puts, calls, and everything in between, all the different combinations. So learning all of those took a while to learn all those relationships between the different combinations of options trade, and what people are betting on. Like, if somebody's buying a straddle, it's a lot different than if somebody's trading, a call spread, right? So what are they betting on in a call spread? What are they betting on in a straddle? It takes a while to learn all that, but once you kind of get all that down, and then you can do the math in your head pretty quickly, it's the same. Once you know all that, then you can get away from trying to just really just memorize what someone's doing, based on the different trades they're doing, and really see the board and see someone's bidding up, at the money vol, or someone's making a calendar bet, rolling their vol exposure, or this is just a simple, this is basically stock, like trading a combo or trading, a tight risk reversal or something like that. So once you can get through the fundamentals, which takes, months, usually, at the short end, a month. At the long end, people sometimes never get it.
Yeah.
Then you can start to actually see, see the second, level of what's going on the board, and then make your decisions based on that. And that's what you're supposed to be doing.
Any tips on how to speed up that progression for people who can eventually get it?
Yeah. I mean,
would trading on your own help at all, or is it better to do it in that training kind of mock framework?
I mean,
really learn.
I wouldn't advise anyone to take their money and go jump in to start trading
Options.
The iron butterfly 2 months out in Tesla, right?
Oh gosh, too many people shorting Tesla, trying to be heroes.
Yeah, exactly. I would say there are places, and the names of them are escaping me, where you can open a paper money account.
Yeah.
Right. And you can learn the,
they could just Google paper money or mock.
Yeah. Open one of those, open one that has good options functionality, and then learn the Greeks, learn the fundamentals of options, and understand all that at a really, really, core level. And then just trade some paper money stuff and see how it goes, and learn what your different risks are, right? Like I said, trading, somebody say, oh, all you're doing is buying a put and a call. But trading an out of the money straddle is different than trading a front month, at the money straddle versus 2 months out. And you can do straddle swaps, you can do risk reversals, you can do big, wide box trade. There's 1,000 different combinations of different options trades you can do.
Right.
And understanding what your actual risks are and what you're betting on in all of those is important, and how you would hedge them.
So you weren't asked any of that in your interview. It's, I assume, coming from
no. The interview was
they want to know if you're smart.
Yeah, it's poker questions, probabilities. There was a Bayes theory question. There was, an interesting one where there's something that's completely unknowable to me. I think the interviewer asked me what I was supposed to figure out how old he was, and provide a 95% confidence interval for how old he was, by asking him questions that had nothing to do with what year he graduated or stuff where you could really try to back into someone's age. So I asked a bunch of questions like, do you have kids? Did you go to graduate school? You can't ask how old his kids are, but like, what kind of cars do you have? It turns out his wife had a minivan. Does there a TV in the minivan? So I figured he had young kids. He went to grad school. I knew he was a senior person in the firm. So I kind of backed into something. So my confidence interval, or no, he actually asked for a point guess on this one. So I said, okay, I think you're 35. And this was like a 7-minute back and forth.
Yeah.
And then he's like, okay, well, I'm going to offer you a bet. If you're within 1 year on either side, then I'll pay you $10. But for every year you're off, if I'm not 34, 35, or 36, for every year you're off, right, you pay me $20. And I thought about it, and it turned, the point of it is both to see, how I was trying to get information out of him.
Yeah.
And then to see if I could understand that he's supposed to be a rational actor. He's not going to offer me that bet unless he knows he's going to make money because he knows how old he is.
Right.
That was the entire point of the exercise, which is very sneaky, right?
Very sneaky.
But that's what they're looking for. They're looking for people who understand, like, listen, he knows something I don't know. I'm assuming he's rational. He's not going to do something irrational in terms of, something that's going to probabilistically lose him money. Right.
So if he was 39, he was like, yeah, let's do this.
Exactly. It turned out he was like 32 and I would have lost money had I actually taken the bet. Yeah.
Got it. So, okay. So you're at the first shop kind of more as a flow trader, you mentioned, but then you kind of ended up jumping to a place that was more prop.
Yeah.
So tell me about that transition, why you made that transition and what the thought process was, and then what it was like day to day, the differences between the two.
Yeah. So, really it was a market making firm, the first place. So I was an assistant on one of the larger desks there. And my job, from the beginning was to book trades, make sure our risk and P&L were updated, reconcile trades at the end of the day, reconcile everything again in the morning, and, really just execute trades when they came in, meaning posting them to the exchange, posting them with our brokers on the floor on the options exchanges.
So after 6 months a year, you're pretty bored because you're in your pattern of just execution.
Yeah, exactly. And it's hectic, and some of the senior people can be difficult, and there's like no upside because you're never going to do anything great where you're going to make anybody any money.
Yeah.
But you can definitely screw things up where you're going to cost people a lot of money, and that happened. I had a couple of small ones, other people had a couple large ones, and it's stressful. But as things went on past that first 6 months, it became interesting. I got to execute more of my own trades. I got to make my own markets on smaller stuff, and actually got some decision-making capacity. And I really like that, but it's still market making, right? You're still judged on an overall portfolio, which I was a very small contributor to 5% of the trades of our whole book or whatever. Right. Cause the head trader on my desk wasn't going to have me make a decision on anything important that was going to really move the P&L, obviously.
So like when you were making markets, you said it was a small kind of sub market, like where you would be setting you'd be setting the spreads for
yeah. So we had automated quotes and we had people on the floor doing their own quotes. So I would make sure that our quotes are working right and everything. But if let's say one of our sales traders called us and said, hey, hedge fund XYZ wants to do 300 of these options, right? And the head trader is busy because he's trying to trade 1,000 lot somewhere else, right?
Right.
And it's a pretty liquid position, and he only needs to do 300. I'm like, okay, fine. Like I'll put that up for him, and I'll pick something around the current screen bid offer, and then I'll hedge it a little bit with the underlying shares after we execute the trade. But that's the kind of stuff where again you can screw it up and really cost yourself money, but you're not going to make a career off of doing that like on a trading desk.
Got it.
So
that's helpful just to hear that like example. That's to give the listeners kind of a viewpoint in.
Yeah. So on the prop side, it was a slightly different asset class. This firm had a long track record of having 50 plus traders who the firm as a whole was making money every week for like 7 or 8 years. So they really had some alpha on the trading side, which is hard to find. So I like that aspect of it, and the aspect of like I was going into the firm was based elsewhere. I was going to be working right outside of New York City in a satellite office, and it was a small group of traders, very informal. Everybody's got their own book, and they say, "Here's your money," and they give you some guidance from a senior trader like mentor who you kind of work for.
Yeah, go ahead. Though, it seems like you took some time off in between. Was this because you just like
I had a severance agreement.
Severance. Okay, so you had to wait for a little while. Okay,
I had to wait a little bit. Yeah.
So can you tell me when you started there? Do they start you off with like a small book? Do you mind telling me what it is? Like
yeah, so they had one specific trade. Yeah, so we traded something that was very highly leverageable. On the fixed income side, so not on the option side, but this was more fixed income and rates.
Yep.
So you can get not infinite leverage, but a lot of leverage. So they actually didn't need a lot of capital to do a significant amount of trading, especially if you planned on trying to go home every night flat, right? So you weren't carrying position, small, even small positions could be expensive overnight.
So it was daily kind of not flow trading. What do you call that? Quick high frequency trading, but not like
I'd
super
say
high frequency like
it wasn't super high frequency. I'd say our average hold period was like an hour and a half.
Okay, got it.
Right, we would see it would be kind of hedged in terms of the market goes up, market goes down. We think we're hedged to that. But we were trading little variations and trading in pairs mostly. So it was a little bit of pairs trading across the rates universe. And, we were trying to just find those little discrepancies where one instrument has gone up, but the others haven't caught up. So we'll sell the one that's gone up and buy the other ones. And hopefully that corrects. Yeah.
So a lot of data scientists and stuff like that, or
definitely a lot of data. The firm started with a couple, very quantitative PhD type people there running analysis for us and making sure our risk models were up to date and trying to find new pairs for us to trade that they thought would work out. But it was still, pure clicking.
But then how do you think they were so successful for so long then doing that? I mean, was it just because they were in a small enough market where they could kind of get a little edge?
It was a very large market, but it was bifurcated amongst a bunch of different trading platforms. And the guy who started the firm created the first technology solution to kind of aggregate trading and risk across these different platforms where you had to trade different instruments on, I'll just tell you, it was treasury bonds and futures, right? So you used to trade treasury bonds on eSpeed and BrokerTech, which were broker-owned systems. The treasury futures used to trade on the CBOE, which is bought by CME. So kind of
he was able to somehow attach some sort of
attaching all of that, getting a system where you could trade all those at once and trade as one trade, saying like, hey, I want to buy the 5-year bond and sell the 5-year futures, and that's one trade that's going to execute at the same time across 4 different markets maybe.
Got it.
Like that was a pretty
big deal. That was a big deal.
Yeah, pretty impactful solution at the time.
Very cool. Got it.
But there's a second half to this story.
So what happened? Why not stay there and ride off into the sunset with your million?
Well, that's believe me, a lot of people did who had been there for years before that. But what happened was, people saw firms like this one making a lot of money on this trade, and they had better technology. And I know for a fact that a couple high frequency Chicago-based firms came into our exact trade and just ate the firm's lunch. So I was with this same small group of traders. We left the original firm. We started our own thing for a little bit. And then our own thing kind of not blew up. It just didn't take off the way we wanted it to. And the 2 guys who put up most of the money had a life change. And they needed to, get some of their money out. So we ended up joining a larger Chicago trading firm, again. So this little group of 5 guys kind of went from this original firm to our own thing to another larger firm. But by that time, the writing was on the wall that this wasn't going to work out the way I kind of wanted it to at the time. And I could have gotten other trading jobs, but I just didn't like where it was leading me. Like I was interviewing for jobs at, large execution trader at a large, well-known hedge fund, for example.
Yep.
And they're like, hey, we love your resume. You'd be perfect for this. But there's a guy who has 5 more years of experience than you from Goldman who's willing to work in the same position for the same salary. And we have to hire, it's just logical. We have to hire him instead of you. And that happened like 2 or 3 times. And I'm like, all right, this is not good. Like, I got to go do
Well,
something else.
this was right after the financial crisis too.
I
So
mean, this was right in the middle. This was 2009. Yeah.
9, 10. Yeah. So it's like,
Yeah.
there's just, the street was flooded with incredible talent.
Yeah, it was. Yeah. And a lot of people wrote it out and stayed in trading or wrote it out and found different areas, whether it was, servicing trading or, doing other kind of things around the trading ecosystem and exchange or elsewhere.
Yeah.
But I mean, let's put it this way. I worked with probably 200 different like youngish traders, call it under 30-year-old traders, across 4 or 5 years. And I think like less than 10 of them are still trading now.
Wow. That's crazy.
So a lot of attrition too.
Before we jump into kind of your business school thing, any comments on how things have moved kind of 10 years later now in terms of just gotten more data comp sci heavy, obviously more automated?
Yeah.
Tell me a little bit about your thoughts in terms of your perspective. I know you haven't been in it for almost a decade.
I still cover like that ecosystem a little bit and still pay attention to what's going on. It's just a tough market for jobs there. I mean, the largest, employers of traders and sales and trading are obviously still the banks, but I'd say the vast majority of people who go into sales and trading in a bank, you end up more in a salesy type role than a, real proprietary decision maker as a trader type role. And it's not, I'm not saying it never happens, but like they pick a very select few of every class to say, listen, if we're going to have some people with proprietary capacity, like, after training or as people start on the desk, those people get identified and kind of siphoned off into more what I would consider real like market making or flow trading type roles. Most of the people end up, in a more salesy type role where you're covering asset management clients. You have to understand the markets. You may have some proprietary capacity to trade against your clients or execute things on an agency basis, but it's not the same to me. They're two kind of different skill sets. One's relationship driven and one's more like, a lot of the best traders, they lock them in a room. They don't even let them talk to clients because 1, they don't want the clients picking their brain. And 2, they tend to be prickly people whose time is best spent, focusing on the markets and their screens.
Yep.
So I'd say from my perspective, proprietary trading, at a bank is tough.
What about at a hedge fund? Like, what about hedge funds?
Yeah, hedge funds. So there's lots of great, independent trading firms. Just to rattle off a few off the top of my head that hire a lot of people out of undergrad. Now, a lot of these firms tend to now focus on people who have like intensely quantitative backgrounds. But you can still talk a few of them into, an interview. And if you do well in the interview, I'm sure you can get in there. If you just prove some analytical value to them, whether it's in gambling or otherwise. So firms like Peak Six, Wolverine, Susquehanna, Jane Street, maybe a little bit less so Jane Street. Who are some IMC, Optiver on the European side?
A lot in Chicago.
A lot in Chicago, There, a lot of them were, a lot of options firms and futures floor traders out of the Chicago.
Are those teams growing at all at those prop shops? Or are they staying the same size and kind of there's some attrition?
Yeah. My guess is they're staying the same size.
Yeah.
The industry's been consolidating. What you've seen, for example, on the equity side over the past 10 years with Virtu kind of has just hoovered up every one of their, main competitors almost.
Yeah.
That's going to continue happening across other asset classes, whether it's FX or futures or options, especially. I mean, options and index and ETFs options especially has lent itself to growing these huge firms that trade everything because you're trading underlying, especially ETF and index, right? You're trading the futures, the cash, baskets of stocks. You're trading multiple different classes of futures. You're trading options on the futures. You're trading options on the cash. You're trading all the ETFs. And there's, for the S&P 500, there's probably, 100 plus ETFs that are highly correlated to the S&P 500, if not directly linked to that index.
Yep.
So it just creates these huge behemoths of firms that are good at all of this stuff.
Yeah.
So I would expect that it's going to continue consolidating. Those firms may be growing their classes, but when you think about they're going to acquire 3 other firms that do similar things, that used to hire 10 people a year, like it's all going to continue to get hoovered up by the largest, most successful firms.
Fair. Fair.
So it was a great experience. But
you saw the writing on the wall.
I saw the writing on the wall.
What was that? What was that kind of that day or that break where it was like maybe you were like, I just got to go to business school, or I need to go to banking. Like, and why banking?
Because I had been, like I said, I had been interviewing around, and not
this
just
2009, 2010.
This is 2009, 2010.
It's a bad time.
It was awful time, and I was trying to find, even I was open to leaving trading, but I just kept running into the same headwinds of like, oh, how are you going to convince me you're not going to jump right back to trading once the job market gets better? Or great, like we agree that you're analytical and you can answer all these great logic questions and whatever, but like I don't care about that. I need somebody who's good at PowerPoint who can put together a sim, right? Like, and they both are skill sets. It just happened that I had one at the time and I didn't have a great one. I was good in Excel, but like I said, I didn't know anything about accounting or corporate finance.
It's interesting that they don't really care about raw intellectual horsepower. They care about just how much
at the time,
how hard you're willing to draw.
For experienced hires, that was at the time. I mean, I was competing for a lot of roles that weren't necessarily in banking, but they were similar skill sets. And they're like, why am I going to hire this guy who is a trader and he'll take 3 months for me to teach him everything when I can just hire an analyst from any investment bank who's been doing this for the last 2 years?
Yeah, it's true.
It's 100% true now that I've worked with lots of analysts.
So tell me a little bit about just that decision, the year. What is like when you made the decision to go MBA? You said top 20. Was it the top business school? Why go there then? Why not?
It was a timing thing. It was really. It was the fall. It was like late in the fall, and I was, when we started our own shop, like we all had to put up some money, and then. I was the most junior guy and I didn't have the money. I didn't want to I had savings, but I didn't want to put up my money and like just dive into this further at the moment. So I basically said, listen, I'm not going to take a salary, but like I'll fill up my partner capital first. And then like I'll go and I'll start paying myself after that with my cut of profits. And what happened was the market got so volatile in the summer and fall of 2009. If you think about, especially the treasury market, like we were in the heart of quantitative easing, like, things were only going one way and in kind of uncorrelated fashion. Sometimes you can imagine when the Federal Reserve is in buying treasury bonds, things tend to go wild. I mean, all risk parameters that we had got blown out. And like, it was just a completely unsure footing, and the partners just cut everyone else's risk besides themselves to a point where like it was uneconomic for me to show up every day. Like they cut my risk so much that I didn't have visibility into filling up my partner capital and being able to pay myself for any time in the foreseeable future.
Got it.
And
what does that mean? They cut your risk? Like you weren't allowed to put on anything.
Yeah, I wasn't allowed to have positions on of a size where I thought I was going to be able to make money over my nut, which my nut was I had to make like, I don't know, it was like $12,500 a month to cover our like tiny little office rent and connectivity and stuff. Yeah. Right. So if I had to cover my nut and then I had to come up with like 50 G's to fill up my partner piece. Yeah. And I just thought like, this is going to take 6 months. I can't work for nothing for 6 months. Yeah. And so I was interviewing and finally like, I just like capitulated and I always said like, there's no way I'm going to need an MBA. Like because in trading, like if you're good at it, you can go as far as the world will take you.
It was the last option.
No. It was really,
Well, that's honest. Okay, so
so I took like 2 weeks to study for the GMATs and signed up for a GMAT. Like the only time I could get, and I was in the New York area. Around the New York area, it was like right before the holidays. Was like a 6 a.m. slot. It was like an hour and a half away. So I like got up at 3:30 a.m., drove in there, had breakfast, and like took the GMATs after studying for like a week and a half. Yeah. And I picked 5 schools. I applied to a couple really good ones, a couple middle tier, and one kind of safety. I was on some wait lists with the top, it was 2 top 5 schools. I got on one wait list. I was on another wait list for the middle one, and then I got into the other middle one where I ended up going. And I didn't choose the schools, willy-nilly or just on name recognition. I chose ones that I knew had good track records in banking recruiting. Yep. Especially, with firms in the New York area, which I wanted to be back in New York. Got it. So, I was weighing do I want to wait on the top 5 one on the wait list and these were extremely competitive years for MBA.
Yeah.
If you remember correctly, like if you look at, I
Everyone's
look at
like
MBA,
run. Everyone's unemployed.
yeah,
And
exactly.
everyone's like
Everyone
jumping.
was running. Yeah, everyone was running for their, their 2-year vacation of MBA, with being a little bit flippant about it. But so yeah, I was weighing, like, do I want to wait this one out or should I just go? And if I waited it out and I didn't get in, like, I would have probably retaken the GMATs to try to get a little bit higher score, because I wasn't like completely happy with my score. And I would have done the whole recruiting process, which, I didn't realize then, but I realize now after going to MBA, like, the recruiting process for MBA is just, do we think that it's like mimics a corporate recruiting process, because they want to see if you're going to be good at getting a job eventually, right? After you get to the program.
Yeah.
So it's like, have you done your research? Do you know why you want to come here? Have you talked to alums? Do you know the specific, the differences between the school versus our 3 biggest competitors? What value we bring versus what they are better at, stuff like that. And that's really just them screening for people that they think are going to do all the legwork and do a good job, when they're looking for their job after they get to the program.
Right. So their placement stats look good when they're done.
Exactly.
Okay.
So I decided I didn't feel like waiting a year, and I said, let's do it. So I accepted the MBA offer, like, in the winter. Still traded for a couple more months and told my bosses that I was leaving. And yeah, so I had a couple months off in the summer to kind of get ready. And obviously they give you like those like MBA like pre-prep courses where you actually take accounting and you take corporate finance and stuff like that. So I was ready to go by the time I got there in July.
And did you take out some loans just to help finance your
I took the whole spiel.
Very nice.
And it turns out not getting paid for like almost a year can really put a dent in your finances.
Yes, especially if you're at an MBA.
Exactly. No, I made like $15,000 total the year before I went. So
that's tough.
I was, and
then you're at MBA for 2 years.
Then I was MBA for 2 years, obviously enjoying myself as well as studying. So came out of MBA, and I actually bought a condo in the worst month to ever buy a condo in the history of the United States, September of 2007.
Oh, so
I was in a very interesting financial picture, which is another attractive thing about investment banking.
Do you want to share where the condo was or no?
It wasn't. It was in the Mid-Atlantic, in a city. No, it was a decent market, not a great one, not awful.
Okay.
Yeah. Not in
Phoenix
Las Vegas
or something. Yeah, or Miami. Okay.
I still have friends, by the way, who are underwater on their houses they bought in Charlotte, like in 2008. But as an aside.
Okay. So you come out. I
come out. I'm like,
you're already in. You know what you want. You're kind of interviewing right away, doing the whole cocktail hours, and tell me a little bit about that whole process. And was it surprising? Did you feel like you had a good shot all the way through? Summer associate tough?
Yeah, I was a little surprised that, like, because I had been trying to find a new job for over a year probably, and I was like, oh, great. Now I'm going to be in this program and I'll get a really good footing and I'll get a little break from the job search. And like the first thing you do when you get there is get your resume ready, get your network ready. What do you want to do? What's your mission statement? What's your elevator pitch? Like that's like the first week.
Yeah.
So it's like right into recruiting, and then you're right into, I think I spent like a combined day on the Bolt bus and the Mega bus going to New York. Like getting, doing the networking events and coffee chats with alums who, and, new MBA associates who came out of my school and were at the different banks.
Mm-hmm.
And from there, it was just every one of those conversations, it's trying to pick up something that you can use in a later conversation that you didn't know about the industry, that you didn't know about a firm, and then demonstrating some kind of value to them, like ask a good question, have an interesting thought, have something from your background that is germane to them in whatever industry they cover.
Did you know all this stuff before the MBA? Did the MBA help guide you, or was it something?
The MBA, they were good at preparing you for all this, right? And your first a hierarchy of resources are available at most MBA programs. First is the second years, because they just went through this last year, and they are willing to help. And part of the value that they bring to their prospective full-time employers, and most people sign up for full-time before they even like leave their summer,
Right.
is to identify the good candidates for next year and make sure that everyone, they're getting the best quality candidates in for their networking events and applying and stuff like that.
But I assume there's a lot of kids targeting banking out of your school.
Yeah, there were.
Pretty competitive. And like, were you worried ever at some point, like, oh man, I'm dropping all this money on this MBA and the economy's still not humming and I could come out with nothing?
I was a little worried. So I considered like trying to go to a hedge fund. There was an alum at a hedge fund that we like kind of clicked, and he was like, I'm not going to know if we're going to need any interns till like April.
Yeah.
And I thought about it, and I'm like, I just can't do it. Like, I need the paycheck, and I came here to do banking. Like, I want the skill set, at least for the summer. We'll see. If I hate it after the summer, I'll figure it out. But like, let me get like an offer for the summer.
Tell me how was that summer, not having any of that accounting, at least on the job, or any of that financial?
I mean, it was fine. Banking's not rocket science, right? Like, you're not doing really highly quantitative stuff. It's just nuts and bolts of, you're just learning the nuts and bolts of how banking works, which is its own little esoteric, part of finance, which the only way you can learn, you can take as many classes as you want, but the only way you can learn is to sit there as an analyst or a junior associate and really, dig in, learn how to model, learn the differences in business models between clients in your coverage universe, learn why you adjust someone's earnings for something, but you don't adjust someone else's earnings for something, and how that changes their multiples, or how it changes how you think about them, like if one of them gets acquired in an M&A context and stuff like that.
Yeah.
And then how the whole process works too, how a pitch process works. So, going to a client for a quick catch up where you're going to bring 10 pages that are mostly off the shelf is a lot different than, responding to an IPO RFP that you're going to work on for 3 weeks and it's going to be turned 175 times. Right. But like going into banking, you're like, oh, one's a pitch, the other one's a pitch. They're like the same, but could not be further from the truth.
Yeah.
So learning all that stuff was interesting, but the nuts and bolts of it are, I don't know, pretty easy. And luckily one of my really good friends at business school had been a bulge bracket analyst, through the beginning of the crisis there. And he was, he really kind of gave me the ropes of, what the different job roles are, what you can expect your work-life balance to be, what types of MDs, there are between the execution side of things or more coverage, or very senior people who are like the managing director of having lunch and never generated work for junior people. So it was a good, like, a little bit of a cynical view, which also helps, but because he was going to business school to leave banking, I was going to business school to get into banking.
He's like the jaded analyst after 2 years.
Exactly. So no, the summer was fine. I got split between two industry groups that were not FIG. So all of that whole spiel I gave about going into something where I had a little bit of operational knowledge didn't really apply. Like, I spent my summer in healthcare and something else that I knew nothing about.
Okay.
But the learning experience isn't about the sector. The learning experience is how banking works.
The process. Yep. Okay.
Process wise. Yeah.
So you're there. It sounds like you get the full-time offer, right? At the end of the summer. In terms of they also pay you over the summer, which is nice. You need that paycheck.
Yeah, pretty well. Yeah.
And then, were the hours about 70, 80 hours a week or so?
I'd say on average it was like 80, and then I had a couple bad weeks that were 100 plus. Maybe 2 weeks were bad.
Okay. And so you still came out of that and you said, okay, I'm just going to go for this because you got the offer.
Well, one thing they do is they dangle like 50 grand in front of you that you can have like the next week. Like if you sign.
Okay, signing bonus.
So I investigated lateraling, not lateraling, but switching from my internship to full time.
Yep.
But at the time, like, these weren't big classes at a lot of banks, and everyone was accepting their offers because
it was risky at this
the economy was still in crisis.
Yeah.
So that quickly went by the wayside, and I pretty quickly took my return offer.
Fair. Okay. And then
but I did caveat that I needed to be in FIG.
Got it.
Which, they made a concession on that.
Got it. Okay. And so you basically had, do you feel like that's a little bit unique that you want to be in FIG? Because I've heard some people say they don't want to be in FIG.
I think
makes them?
Yeah, I think it is unique.
Yeah.
Because people, especially analysts, I hear this from our analysts a lot, like, oh, we don't want to get pigeonholed, and spend all of our time working in depots or insurance, and then like I'm doing that for the rest of my life. And everyone thinks that working in depots or insurance hurts your buy side hireability.
What's your thought on that?
I think most banks realize that, and they're going to make sure that you get a diverse experience where you're working with both companies that are balance sheet based, whether it's depots, insurance, specialty finance, whatever, and you're working with some EBITDA companies, right, where you're actually doing, a fig EBITDA company
at a junior level. What about
Exactly.
yourself? Because you did say something about buy side. What about you being in that group? Was buy side on the radar at all when you were coming out of business school?
Yeah, it was. I mean, like I said, banking. I always viewed banking as a stepping stone.
Yeah.
I didn't think it was going to be,
but it hasn't been. You've been
almost 10 years.
You're like a banker for life right now at this stage.
Yeah, well, not quite, but
yeah. Well, no, but you've been there for a good number of years.
Yeah.
But yeah, tell me a little bit about just the.
You can get pigeonholed to fig specific things, which is fine from my perspective, because fig is a large part of a lot of different investment funds, right? So the mega funds, like what percentage of Blackstone or Carlyle? I mean, Carlyle had their own dedicated fig fund.
Yep.
That just wrapped up a couple of 2 years ago or something. And there's plenty of dedicated fig buy side shops that do really well. Stone Point and Lightyear and Flowers, and there's 10 other ones.
Yep.
Aquiline. So I thought there was enough of a buy side ecosystem where I was comfortable that that would be an alternative at some time in the future. And fig investing has only exploded really since I've been a banker, pretty much, with one thing: all of the big alternative managers getting into insurance. So Apollo with Athene being the first one, then Blackstone's got their insurance operations. They bought a platform, FGL, a couple of years ago. KKR just bought Global Atlantic 2 weeks ago. So now all of these big, powerhouse private equity firms need people who know how to invest in insurance assets as well,
That's a good point.
to understand the insurance side of a balance sheet. So a guy I worked with actually, who was a managing director at a prior firm, he covered alternative asset management with me a little bit, but he also spent a lot of time in insurance, and he ended up getting hired at one of these firms to help, both do some fig investing, some kind of corporate development for the house, but do a lot of help us grow our insurance business.
Wow. Yeah.
Sounds through acquisition. Yeah.
So you're there. Yeah. So you were there for a few years, and you had that opportunity, like you said, to kind of go from the middle market to the bulge bracket, and try to get more on some kind of be the lead at the level of the deals, kind of improving. And so you did that after a few years. Was there any sort of pay bump that went along with that? I mean, I assume you're getting standard associate pay.
Yeah.
You didn't get promoted to VP till that bulge bracket.
Yeah. So transition. There was a small pay bump from the middle market. I mean, not on the salary side. Yeah. The salary was the same, or I even took a little bit of a decrease.
Yep.
Actually, but the bonus was, not like 50% increase, but probably like 20.
That matters.
So it was a good pay bump, but I also had to take stock. So at the middle market firm, I didn't have to take any stock. At the bulge bracket, I had to take stock, and unfortunately, it only went one direction while I was there.
And that was like a restricted stock units. You had to wait for them to vest, or they were.
Yeah. 3 year.
Got it. So in terms, and was it always rolling? So every year you'd get a big chunk of it.
Every year you'd have to get a bunch of it. And when I eventually switched to Goldman, that's part of a package. When you switch and you have stock, they usually replace your stock. Yeah.
They try to make you whole. They try to.
Yeah.
Great. So talk to me about kind of that final transition. To me personally, looking at your background, and you're saying, potentially buy side, like why not just stay where you are and get director or manage director?
So this was a little bit of a personal, it just happened to be the area I cover. I would look around and look at a bunch of my clients and say, oh, you work with people, and you say, hey, that guy's a great guy. And like, he's got an awesome job, right? He's corp dev at a big public private equity firm, or he's one of the guys at, one of these platforms that's doing GP minority stakes like Dial and Blackstone and Peterson, which I cover them now. I know them really well.
Yep.
And like, oh, that'd be I would love to have a job like that. Or, he just got hired out of the bank and now he's a VP at one of these FIG focused buyout firms like Lightyear, Aqualine, or Stone Point. And overwhelmingly, when I would do that, the background of that person was they worked at Goldman. Like 80% of it. If I did that with 20 people, I swear like 15 or 16 of them worked at Goldman. And it's probably a little bit of just, luck on that end. Mm-hmm. Because, I've met lots of people with great jobs who never, who worked at lots of different types of banks or were consultants or did 50 different things, right?
Yeah.
But it just so happened in the alternative asset management industry, for these people who tended to be like my level or a little bit above at the time, like a lot of them had this very similar seat where they left when they were either a VP or junior managing director at Goldman.
It's really interesting. Yeah, I didn't know.
So I figured, listen, if I'm going to, really try to do it and put myself in the best position to get that next seat, that next seat where I'm going to make hopefully like the vast majority of the money for my entire career. And I'm hoping I'm there for 15 years and become a senior partner or whatever. Like, this is my career, right? Yeah. Everything up to this, from trading, has, one of the things I was going to mention is the benefits of flexibility and being able to pivot to other things, right? So pivoting from trading to business school to banking to a couple different firms, all leading up to this next job. I thought the best place to do that from would be Goldman versus the firm that I was working at previously.
Yeah, that makes sense. I mean, if you're looking at the path, you're looking at the path of other people who've done it before. It makes sense.
Yeah, and that makes the cost of switching. What got me past the cost of switching, which was giving up, a pretty easy path up. Yeah.
So, in terms of easy path up all the way to MD.
Easy path up and being rated well every year and having a good, network in terms of supporters throughout the firm at my old firm, and going into Goldman, which, is known to be a little bureaucratic and a little bit more competitive than other places, put it that way.
Makes sense. Okay. Yeah. So before we call it, anything else you'd like to share for the younger listeners? I mean, your path's been interesting, traders going to banking and making that transition. But
yeah, I would like to reiterate, being flexible, being open to opportunities, and just because you didn't go to a school that is like a core recruiting school, or just because you didn't start in your first job at, Goldman or JP or Morgan Stanley, like, after a while, like, people care less about where you went to school. They care less about where did you start your career. It's, you're in a room with someone and your industry, you can talk knowledgeably about the deals you've worked on. You can talk knowledgeably about the clients and the sector that you cover. You can talk knowledgeably about what's going on in the economy in that industry. And after a while, that trumps everything. So, when I was at this European bank, like, we would hire people from Ivy League schools. We would hire people from, Midwestern state schools. We would hire people from all over, and just based on, senior people, and they could get, people in there for interviewing. And to tell you the truth, our best analysts when I was a staffer, 3 years in a row when I was there, were probably from schools that you would never assume would even have anyone going into banking in New York, from Midwestern Big Ten schools. Like, and not like Michigan, like other ones.
Like other no name, like
really, and those guys, and those guys like killed it. And our worst analyst was from Princeton. So like, once you get in, like, you need to do the job, A, and B, like, people stop caring about all that stuff. And I know when you're in school, you get caught up with it, and you get caught up with I need to go to the best firm. I need to, like, the goal should be, I need to get a seat in banking because I want to do banking and learn, which you can do at a lot of different places. And then if you want to switch to a better firm, you go into that interview with the other firm, right, or the higher tier or the bulge bracket, and you say, you know what, we only did one lead M&A deal, but here's what I did with it. I built the whole merger model. I did the SIM. I ran the whole diligence process. I kept the buyer list. I ran, X, Y, and Z, talk about it for 45 minutes, know all the nuts and bolts of it. and you'll just blow someone's socks off and, have an offer before you even know it.
Yeah.
But that's different than saying, oh, I'm not going to get a job at Goldman or JP or Morgan Stanley, and I shouldn't even do banking if I
yeah, there's a lot of that on the forums. Unfortunately, I try to.
Well, that's why I brought it up, and
It's important. It's important.
A lot of very not I've been moderately successful, making my way kind of along in banking, but I work with a lot of people who founders of private equity firms and hedge funds who the path wasn't as they expected. Maybe they tried to launch their firm and struck out the first time around, or maybe they were at a corporate and they thought that they had a startup that was hugely valued and it blew up, and then they had to go pivot to something else. But, there are benefits of being versatile and flexible as you move throughout your career, and you never know how things are going to work out. But, every experience ends up being valuable. And as long as you're dedicated, willing to do the work, willing to learn, things tend to work out more often than not. And people recognize that. We hired lots of analysts and associates laterally when I was at the other bulge bracket, and now at Goldman, from firms that you would never expect. Small regional shops, middle market boutiques, stuff like that. Just because someone comes in and you can just tell they can do the work, and it's no different. Just the numbers are bigger.
Yeah, for sure. That's awesome.
Yeah.
Well, listen, thanks so much for taking the time to share your story and your knowledge with all of us.
No problem.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. Until next time.